Lucid chart makes
but this is certainly not talking my book. Reckitt, you mentioned this one. This could be one to watch. It's not been a great performer of late on the FTSE, so we will certainly watch that maker of all sorts as its like-for-like sales numbers come in better than expected. Lloyds Banking Group in focus, Roche in focus, a host of European corporates reporting this morning, and the overlay on top of that has been that tech strength coming out of the US latterly. Let us see where we open these markets then. The FTSE 100 out the blocks first, but is pretty flat. The DAX also flat this morning. Actually, the FTSE just getting a bit of a boost then, up by 0.3%. We're waiting for that French market to open up. Our producer rightly guiding us that could take a little time this morning because Kering is such a big heavy weight on that market. So we'll be looking for any detail we get on the luxury space when we get an opening price on Kering.
Yeah, we are still waiting on Kering, but you are already seeing the likes of LVMH, for example, trade, and of course trade lower. It's already right off the bat one of the biggest index weights that you are seeing on the Stoxx 50. To the upside, though, it seems to be a commodity-driven move to the upside. Of course, ASML is going to be your biggest index contributor when we're looking at the Stoxx 600. We are still waiting for more trades, a little bit more volume on that, but early on, you are seeing higher by about 2.5%. And the next ones you've got is Novo Nordisk, and then a slew of commodity names: Rio Tinto, Shell, BP, Total, for example.
Okay, yeah, there's a host of moves then. Let's have a quick look at where we are on those sectors. Basic resources does seem to be the best performing sector this morning, and so often this sector is one that takes its clues from the underlying metals. So we look to that, of course. But that sector up by 1.7%. On the technology space, you've mentioned some of those, and this picking up where we left off, perhaps in the US and the Asia session. We see a bit of strength coming through on some of those technology names this morning. Texas Instruments. We heard Tom at the end of the last program talking about this one. Sentiment better there. So is that going to be something that boosts sentiment, in the European low-end chip makers? But that's certainly a sector that we're watching then this morning.
We are, and we should also mention that Lloyds that we were watching earlier on now down about 2%. This morning. Again, it's bringing us back the question of the mortgage market, bringing us back the mention of these kind of net interest margins. I believe we have a slew of banking earnings tomorrow morning as well. What is the macro read-through into the micro that we continue to see? That's going to be, I think, top of my agenda. But alongside Lloyds, you're seeing a lot of the banking stocks actually lower and under pressure this morning when it comes to weighting down at least the FTSE.
Yeah, absolutely. The banking sector is down by 0.2% this morning, so it's one of those sectors that's falling. We've got about 2/3 of sectors in positive territory and a third lower. Just worth pointing out a few of the moves that are on the stocks that we've been following this morning. Then Volvo Cars down by quite substantially this morning. It was down by 7% last time I checked. So the car sector very firmly in focus for us. That takes us nicely onto the US consumer and the state of the US economy more broadly, perhaps. US exceptionalism, the strength of the US economy has been something we've returned to time and again since the start of this year. It's reset expectations almost continually around what we get on the Fed. Let's listen to what Jamie Dimon had to say, of course, the JP Morgan CEO, around the US economy, around the US consumer, and the role that fiscal policy is crucially playing.
Even when we go to recession, the consumer's in good shape. But that doesn't mean you can fight off the effects of stagflation or something like that if it gets much worse. And so I worry that it looks more like the 70s than we've seen before. If you go back to the 70s, deficits were half what they are today. The debt to GDP was 35%, not 100%. And so part of the reason I think we've had this strong growth is the fiscal spending.
That was JP Morgan CEO Jamie Dimon speaking at the Economic Club of New York and ending there on that fiscal argument. Really good place to start our conversation with Daniel O'Keefe, lead portfolio manager of the Global Value and Select Equity Funds at Artisan Partners. Very nice to speak to you, Daniel. Thanks for joining us. And it's interesting, he was mentioning, Jamie Dimon there, mentioning the role that fiscal policy has played. And I know when you think about the US economy and the strong growth story we've seen this year, you think that part of the reason we haven't seen more effect from higher rates is because of that fiscal impulse. Explain a little more.
Yeah, I mean, it's very interesting. The market and a lot of business people are obsessed with this idea that we need to cut rates, but we're borrowing 6% plus of GDP on the fiscal side, which in my view is more than offsetting, you know, the restraining effect of the interest rate increases. So we've got the best performing economy in the world. We're doing very well. Why do we need to cut interest rates? And no one's talking about, you know, the fiscal side of the equation when we're thinking about the U.S. economy. That's clearly driving the U.S. economy and clearly driving inflation.
Okay, so if we don't get, so if we only get a couple of interest rate cuts this year, or dare we say it, if we don't get any interest rate cuts this year from the Fed, do you think stocks should be okay, sentiment should be okay, because it should be comforted by the fact that this is, to quote our colleague in the last hour, for good reason? It's because of U.S. economic outperformance.
Yeah, well, I don't think there should be any interest rate cuts. I mean, I think it's absurd. Maybe there will be, maybe there won't. I don't think there should be. We don't need them. You know, the economy is being driven by a strong consumer. It's being driven by government stimulus, and earnings are leading the way. So it's a healthier market, in my opinion, for the market to be driven by earnings rather than interest rate cuts.
Daniel, stick with us for 1 second. I just want to bring breaking headlines coming when we're watching Caring now. The stock is now officially open, down about 8%. And of course, one of your major weights that you were seeing this morning, your biggest index, third biggest index contributor, of course, bleeding into LVMH as well. We're going to let a few more trades kind of help shake out, but just want to bring the initial pricing to our global audience. I want to bring it back from the macro conversation to that fiscal stimulus you were talking about from the States. This has never happened in history. We've seen this many rate hikes matched with this much profit growth. It's never happened at the same time. What happens when the fiscal impulse potentially abates in 2025, depending on who the next president of the United States is, or simply because of deficit issues? When does the market price that in?
Well, I don't know. I mean, there's absolutely no debate within the country, unfortunately, about restraining the spending, and it's unsustainable. It's clearly the major threat to U.S. economic dominance in the medium term. Trump never showed any fiscal discipline when he was president, and Biden has clearly shown none either. So I don't know what the end game is. Usually politicians only do the right thing when they've tried everything else. Yeah. And we're still in the process of them trying everything else. And so it will take a crisis.
So is that something you position for, though, or is this just not on your radar at all, given that we are just a couple months away, 8 months away from the U.S. election and about 9 months away from another debt ceiling conversation?
Investing is more about managing risk than about predictions, because predictions are almost always wrong. So we manage risk.
How are you managing that risk?
We focus on good companies and good balance sheets and valuations, and you don't get too optimistic and you don't get too pessimistic.
Okay, and with that in mind, let's talk about some of the big tech names, because a lot of tech names are reporting this week. I know Meta is one of the top performing stocks that you own. I think you still own, Daniel. What about, give us the best reason to pick this one over others, because a lot of people group either the Mag 7 or just the Magnificent 5 these days together. Why are you focused on Meta?
Well, I mean, we own Meta and we own Google, or Alphabet as it's called now. We like them both. They're great businesses. They're fundamentally very strong. The valuations are not particularly interesting at these prices, to be frank. But we believe in the businesses long term. We've been selling Meta recently. We trimmed it. It was a much larger position. We bought it significantly when it was down 70%, last year, or in 2022. And as it's significantly rebounded, we've trimmed it. But we like the business. We don't particularly like the valuation here, to be honest.
And do you want the company to focus on, a solid balance sheet and the P&L, or do you want them to to be more experimental. These sort of seems to go in waves and cycles, and we see periods where the market tolerates quite a lot of spend on R&D, and then periods where the business gets the message and pulls that back.
Well, I mean, they're flushing a lot of good money down the drain, on this whole metaverse, and we wish they would stop. Other than that, capital allocation is very good. I think the metaverse is sort of an embedded option, in the valuation of Meta. They're spending $10-15 billion a year that's generating no return. If they stopped, the valuation would look much more interesting. We hope they do, but that's an option you're not really paying for right now.
Right, so you're not too worried. What about spending on AI? Would you put that in the same box, or no, that's what they should be doing?
No, I mean, their AI is going to be a significant beneficiary for Meta. It's going to help make their advertising algorithm more effective. It already is. Before everyone was jumping on the AI train, Meta was talking about machine learning, and using machine learning to make their advertising algorithms more effective. And it's working. And I think it will continue to work. I think they will continue to be a beneficiary of AI over a very long period of time.
We talked about Meta. Let's talk about Alphabet as well. You said you have a significant position there. Is the bet on Alphabet a consumer-driven bet based on advertising, or is it a business investment bet? What's the bull case for Alphabet?
Well, I mean, their biggest business is advertising, right? Which is ultimately businesses using Alphabet to reach consumers. So it depends on how you want to look at that.
How do you look at it?
Well, I mean, it's driven by the advertising market, and it's driven by the continued secular shift of advertising towards online. I think that will continue. It's a very, very strong business. And AI, people get very excited about AI, but the truth is the profits are, for the most part, on the come. And businesses like Alphabet and Meta, for example, will use AI as a tool to make their businesses more efficient, more profitable, and better advertising mousetraps. So that's going to happen over a very long period of time. People shouldn't expect AI to, flip a switch and the profits start gushing.
Very quickly, what is that time horizon, though? Are we talking 5 years, 10 years, 50? For returns on that?
I think you will see AI play out over a long period of time, just as you saw the internet play out over a long period of time. So we'll be talking about it in 10 years for sure.
All right, Daniel O'Keefe there, lead portfolio manager of Artisan Partners, breaking down some of the nuances in the tech space as well. And as we talk about those heavyweights in the States, let's talk about the heavyweights right here in Europe. And I'm going to put my Guy Johnson hat, or Guy Johnson tie on at the moment, and explore the sensational 6 numbers, specifically because we're seeing the heavyweights actually underperform, the exception, of course, being ASML ahead of that big investor day. It's the only stock, green on the screen this morning, higher by 2.4%. The LVMH story is interesting, though. That perhaps a read-through from the Kering pain that we are getting. The Kering shares down still about 8%. LVMH down by 0.6%. They've got that consumer bid there as well. Nestle down about 0.3%. I believe that later in the hour we're going to be talking about Nestle and the Unilever bid as well when it comes to that consumer. But again, it's that luxury read-through that I really have my eye on. Is this a one-day thing, or is there more to it? Which brings us nicely into exactly what Joe Easton has got his eye on. Joe, walk us through what's catching your eye this morning.
So we're going to continue with that luxury theme at Curated, because Kering getting absolutely slammed over in Paris, down 9% at the moment. The stock is trading at the lowest level since 2017, following that massive warning after the market closed last night. As Anna was mentioning, we already did see a report around a month or so ago saying that sales would be weak, but it is much worse than expected, potentially double-digit declines in earnings estimates. According to analysts, they're not doing enough on the high-end space like Louis Vuitton does well in, and also the aspirational buyers not got enough either. That's the view from analysts. Seeing some read across in some of the other peers. LVMH, you mentioned Hermes, Moncler. Moncler does have earnings coming up later today out of Italy. That could be an interesting one. But the moves, really not as much as we're seeing Kering. Hermes actually ticking slightly higher, potentially showing that this is really a Gucci story and an Yves Saint Laurent story, not so much a biggest read across on the market. But in terms of other read acrosses, we're going to look at chips, because these stocks are absolutely soaring today, the best performing sector by some stretch. Now we've got Infineon up around 7%, the best performer on the stock 600. ST Micro doing well, ASML as well. ASMI, the chip machinery firm, had a strong update, and we also got a bullish report out of Texas Instruments after the close last night. All of those boosting the sector today. Auto chips seems to be the big thing out of Texas Instruments, not doing as badly as expected according to them. Then a quick look at some other earnings. We're going to start in the UK on these ones. So we did get Lloyds. This one was dropping, as you mentioned, at the open, down 2.8%. Another easing of net interest margins. Reckitt Benckiser, though, coming back up. The maker of household products doing well, did drop a lot recently given worries about their baby formula unit. That's one of the worst performers on the London market this year, but it's up almost 4% today. Temenos cutting its sales forecast. Interestingly, they say recent short seller report is causing banks to cut back on their software, showing the impact of that Hindenburg report that we saw recently. So Temenos down another 6% today. And Volvo Cars, a surprising weak one because the auto sales, the EV sales actually looked pretty strong in the last quarter, but some concern around margins, the initial take on that one. And Volvo is down sharply today, down almost 7% this morning. Just one deals news to bring you. All funds, disappointment for investors for this one. It's a fintech firm out of Amsterdam. They do data and analytics for the wealth management business, and they're scrapping a sales process, and that is dropping that stock around 8.5%. The worst performer over in Amsterdam. All funds really hit hard this morning. Finally, one morning call. UBS once again. It gets a second downgrade in 2 days. This time it's Citi who cuts the stock this morning. They go neutral from buy, and that stock slipping around 0.9%. Citi say the valuation is too full following a recent rally, and capital worries still linger. So they downgrade that one, and UBS falling once again down over in Switzerland at 0.9%.
Thank you very much, Joe Easton there from our equities team with an update on what we're watching in terms of the market moves. There are so many companies on the move this morning. I just want to mention ASM International. I think actually Joe may have mentioned this one, but rising by 14% this morning, 13.7% as first quarter orders beat estimates, not to be confused with its other larger player within the same space, but that's where we are on the ASMI story in the chip space. Coming up on the programme, we'll stick with things Dutch. Beer volumes beat. The Dutch brewer Heineken reports higher sales for the first quarter. Details next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Markets Today. We're about 19 minutes into the European trading day. You're seeing green across the screen broadly. The one notable exception being in the French index, of course, down about 0.3%. That is really a result of those carrying numbers, down about 8 to 9% in the intraday. But having a read-through is some of the other luxury names, which, again, as a function of being a heavyweight, is going to be weighing that down. We're going to bring you updates as we get them, as some of those trades shake out. I also want to bring to your attention another major market move, and this, of course, with dollar-yen here. You are seeing that currency pair get very, very close to 155. I bring you the intraday here that is going to show you just a little bit of that drop that you are starting to see paired as we get closer to that 155 handle. I believe at 154.95, you saw a bid go into that currency pair. Again, we are on currency intervention watch. We've had commentary come out of Japan. That is something that they say the conditions are right for, but what line in the sand are they actually paying attention to? 154.88 on dollar-yen at the moment. Let's go back to the earnings story and talk a little bit about one of the major stocks we are watching on trading this morning. Heineken has reported higher sales and volumes for the first quarter. The Dutch brewer, the first of the major European brewers to report. Carlsberg, for example, due out next week. We're joined now by Celine Pannuti, JP Morgan's head of Europe Consumer Staples, joins us this morning. Celine, a pleasure to have you on the program. Walk us through the Heineken story here. Some massive numbers when it comes to beer volume growth. 3 months ago when we had this conversation, it was a U.S. consumer resilience story. Is that still what's driving the Heineken growth?
So yes, Heineken today had very strong numbers, more than 4%. There was a bit of an impact from early Easter and some easy comparative, but still, clearly there is a recovery. And what we see is that the recovery is really broad-based across different regions of the world. So it's about emerging markets doing well. We see that India is strong, Vietnam is recovering, Europe as well is recovering. I think we have had an issue of elasticity last year as a lot of brewers raised prices, and we see that with less pricing, beer consumption is coming back. And I must say as well, Latin America was off to a strong start. So I must say it's a broad-based volume recovery, even if there was a bit of a one-off impact from some of the Easter timing I mentioned earlier.
Celine, what does that mean for pricing, though? Is Heineken now finding themselves in a more comfortable environment to hike up their prices and improve their margins?
Right, you know, prices have been increased quite a lot last year to recover cost inflation. We still expect pricing to be up low to mid-single digit in different regions of the world. So beer CPI continues to be positive. We don't expect really right now the focus to be necessarily on incremental pricing, but rather recovering that volume. I think we could be at the right spot this year where the company could recover margin because the cost inflation was behind them. We still see cost inflation ahead, and they're pricing for that. But hopefully, with the volume recovery kicking in, you have the right bet.
Celine, good morning. I want to move our conversation to some of the other corporate earnings we're going to get this week. And I know Unilever is one of the companies that's very much on your radar. We had some stories out at the end of last week talking about Unilever, and that just one example of a company that's reining in its climate ambitions just a little bit, some of its sustainability ambitions, although crucially clinging to others. What's changing in investors' minds that businesses are making that choice? Clearly, we can see what changes in the politics, and in the United States, that's very clear. But what about what's changing for investors? What's the motivation for companies when they make that kind of decision?
Look, I think there is still quite a focus for the company to deliver on their sustainability ambition. At the same time, I think the pendulum probably has to be right. So in the case of Unilever, they were one of the first ones to come with a very ambitious sustainability ambition years ago, probably well ahead of the rest of the street. And I think new management really wants to focus on the operations. So it's, I think, not taking a step back from sustainability, but rather making sure that execution, the focus on delivering numbers on top-line performance is there. And if you look at performance of the share price, clearly will be driven by the ability to recover top-line growth. So I think it's more the company making sure that they have the right, the eyes are in the right ball at this time.
Yes, but given that they have a lot to focus on, Celine, I mean, is it the case that ESG leaders, so companies that have made a big fuss or talked a lot about being leaders on the ESG front in the past, are those businesses under pressure to close valuation gaps that exist across the Atlantic? Is that happening in the consumer sector?
Yeah, I don't really think that ESG leaders, there was a big of a valuation gap. So I can think about, in my sector, a lot of companies that are doing extremely well on ESG and are highly valued, and others that have done well on ESG and are less valued. So I don't really think that necessarily it has an impact on valuation. As I said, what matters is effectively that especially for staple, we see that volume are coming back, and companies like Unilever need to make sure that they showcase that. We were just discussing about Heineken before. Volume recovery is going to be a key driver to share performance.
Celine, have you at all been talking about kind of the inflationary impact on some of the valuations of these stocks? Guy Johnson has been making the point often that you're starting to see a bid, at least in terms of the intraday trade, around some of these consumer staples that kind of looks very similar to what you've seen years ago when buying that commodity basket, buying that food inflation basket served as a hedge. In terms of some of these companies, does that affect the way they're valued?
I mean, clearly, what you've seen is that commodity had an impact on these companies. In fact, two impacts. Number one is that the high cost that they had to cycle, and the bigger impact, in my view, is the fact that they need to raise prices. We've seen unprecedented price increases in the double-digit range that had an impact on volume. And I think what we are looking forward in this year and next is to make sure that we come back to a more balanced delivery of volume and pricing. And so, yes, maybe commodities baskets are as well listening as well in terms of if the total, cost prices have lessened for sure, even if still slightly positive for this year.
Celine, we are going to get numbers out of Nestlé as well, and I know that there's been some reporting recently that talks about an efficiency program there. What's going to be in focus for you?
Yeah, I would say the big surprise at Nestlé over the past couple of quarters has been that they had less volume performance than expected. I think consensus is expecting volume to be down slightly in the first quarter, but management has issued a guidance at the beginning of the year looking for around 4%. So I think the focus really is going to be, as we cycle maybe the last half quarter, how the company can come back to positive volume growth in the upcoming quarters.
Okay, Celine, thanks very much. Celine Pannuti, JP Morgan's head of Europe Consumer Staples. Thank you so much for joining us. With your insights, Heineken, Unilever, Nestlé, the numbers keep on coming. Numbers hitting this morning. Criti's been talking a lot about Kering this morning, and the CAC 40 down by 0.2%, reflecting that weakness in the luxury space. Kering shares hit a 6-year low after a first half profit warning at the Gucci parent. We'll talk about luxury next. This is Bloomberg.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be
already based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
First-time buyers are 30% of our clients, which is a lot. We see a lot of Gen Z and Alpha. 35% of luxury consumers by 2030 are going to be Gen Z and Alpha. It's a hard number to believe, but it's the vibrancy, the vitality is huge because each of those clients has a different set of reasons for why they engage with us. So for Gen Z and Alpha, they buy because they want to buy less and buy better. They want to buy because they see it's a financially wise investment.
That's the Chanel CEO, Lina Nair, speaking exclusively with Bloomberg's Francine Lacroix. And you can see that full interview on Leaders with Lacroix. That's at 9:30 p.m. tonight in New York and tomorrow at 6:30 p.m. in London. So depending where you are watching. Let us stick with all things fashion and luxury and go to the Kering numbers. We have had another update from Kering on the extent of their travails, particularly for the Gucci brand in China. We knew some weeks ago about the difficulty they had in first quarter sales in China, but now we've got how this drops down to the bottom line on their P&L. And the news isn't good, and you can see the effect on the share price. Once again, then Kering down by 7.9%. This very much weighs on the CAC, which is down by 0.2% this morning, underperforming the rest of the markets. Let's talk to Aurélie Husson-Dumoutier, who is a luxury and sporting goods analyst at HSBC Global Research, who covers this stock and the sector and can give us thinking around it. Very good to have you with us, Aurélie. Thanks for coming to join us. So I guess one of the things we were looking for today was a bit more detail as to what it is that's holding the business back in China and some visibility around that. What further visibility have you gained today?
Hello, good morning, and thank you very much for having me. I think the share price reaction that you see with Kering today is just the reflect of what the company has said yesterday evening at a call, saying, first of all, that current trading was not great and that April is actually below the performance of Q1, which implies that there should not be massive improvement in Q2, which we were all more or less expecting a little bit. And the second thing is, of course, as you mentioned, the fact that the indication that they have given for H1 and H2 profits are leading to massive downwards revision from the consensus we have estimated probably around 15%. So this is true that Kering is currently trying to turn around the Gucci brand at a time when the Chinese market, well, the Chinese customer cohort is pretty lackluster. So this is why it's probably going to take more time than originally anticipating.
Yeah, how do you define, Aurélie, how do you define the part of the China market that is coming under this pressure, that is causing these headaches for Gucci? I was reading in our story earlier on one analyst saying, suggesting really that it's too expensive for some consumers and it's too cheap for some consumers, believe it or not. So where does that leave a brand such as Gucci?
This is true that most of the luxury houses have passed on massive price increases during the 2019 and 2023 period by roughly 50%. So that is true. That was one of the reasons why the aspirational consumers was actually flying off the market. So now we tend to see that the richest part of the consumer is still there, but it's probably not enough to drive the volumes for all the brands in the industry.
Arlie, we should mention that I believe you have a €400 price target on the stock at the moment. When we're talking about visibility into the recovery story for Kering, what do you need to see?
Well, we need to see one thing, which is sales picking up. And considering the comparison base that becomes much easier in H2, we hope that can happen. Actually, probably, maybe not in Q3, but at least in Q4.
And when we're bringing it back to kind of the China consumer story, Anna already touched on this, but where does the U.S. consumer fall in here? Can the U.S. consumer make up the gap?
Unfortunately, no, because, the Chinese consumer remains the number one consumer. And that is true that the U.S. has entered a path of more normalized growth, even if in some cases it was actually negative in 2023. So there should be a recovery, but not enough to compensate for the weakness in the Chinese consumer. At HSBC, we expect 7% growth for the luxury market in 2024, and we expect 7% for the US and 4% for mainland China.
Let me focus in a little bit on any read across into other names then, or at least we've talked about what's going wrong at Gucci and the difficulties for Kering. Does this have read across into other businesses, or are they all just so specific, so idiosyncratic that that's not the case?
This is actually kind of a one-off because obviously Gucci is in a turnaround phase. But if you look at LVMH numbers that happened a few days back, the growth in the fashion and leather division was only 2%. So it's also showing, because of high comparison base, that we are entering in a normalization phase. But if we think about Hermès, that should be out tomorrow, consensus expects 15% growth, also because Hermès has been maybe a bit more reasonable during the COVID years and has not increased prices as much as the other. So there is kind of a catch-up effect. So Hermès is embedding a price increase of 8 to 9% that is hopefully and obviously going to help the sales momentum.
And what kind of difference can the management team at Gucci make here, or at least Sabato De Sarno, of course, appointed in January 23. And you hear positive things from management about how new collections are going down. What kind of self-help measures are they taking?
They are spending a lot more on communication, and that is true that the Sabato De Sarno have had kind of a warm welcome from the consumers. The only thing is that they only represent 7% of sales today. It should ramp up to much more by the end of the year, but it seems that management has taken all the actions in order to help the Gucci brand to be reignited.
Arlie, when we talk specifically about kind of, I'm just looking at your valuations here. When you look at kind of the bottom line of Kering in particular, I'm curious why you haven't lowered the price target more.
Well, I must admit that we have had a lot of surprises yesterday in terms of, notably in terms of profit. So leave us sometimes for all the analysts to adjust their numbers.
Fair enough. Fair enough. Orly, we look forward to having you back when you upgrade, or I should say update the analysis. Talk to us then a little bit about the valuation story, because when we continue to see the kind of bid into some of these luxury names, it seems to be largely a European catch-up trade to the U.S. I'm curious what that does to the valuation of luxury as a sector. We'll put Kering to the side for a second. Do you see that kind of outpacing perhaps some of the fundamentals?
Well, when it comes to the luxury goods sector, in terms of stock performance, is entirely linked to sales momentum. And as Q1 and Q2 are going to be pretty lackluster, with some exception, we discussed that, we don't expect the luxury sector to massively outperform indexes until H2 prospects are in sight. So this is why at HSBC we have kind of a cautious view, and we believe valuation are a bit too stretched right now, considering the weak sales momentum.
Okay, thank you very much for joining us. Aurélie Husson-de-Moutier, Luxury and Sporting Goods Analyst at HSBC Global Research. Thanks for being with us. So global trade very much in focus there. Global themes around FX in focus over in Indonesia. Bank Indonesia raising its benchmark interest rate then, Chrissy, to a record high, moving to support the currency, basically. And this was not expected. Only 11 out of 41 economists saw this coming. This decision is lifting the rate to a new high, and it's in response, it seems, to changing expectations around the Fed, what the strength of the dollar is doing to this particular economy, and what Middle East global geopolitical tensions are doing to the strength of the dollar as well, and all that pressuring some of these Asia FX.
And we've continued to see that as well. I'm putting on my Guy Johnson tie again here as well. Our currency year problem. That continues to be the theme. You saw it even in the Japanese story as well. We're continuing to be on currency watch there and for intervention right on the cusp of that 155 level. Do you start to see that show up in the likes of Vietnam, the Korean won, et cetera? They've already seen that commentary come out from Asia.
Yeah, absolutely. So certainly we'll keep an eye on that. The expectations around interest rates shifting quite rapidly, it would seem, in 2024, both from the emerging market side, as we've seen there in Indonesia, but also in the developed market side as well. Coming up, Chrissy, we're going to be talking about China.
We are. We're specifically talking about the geopolitics. They're trying to accusing the United States of sending the wrong signal. An $8 billion aid package for Taiwan. We're finally getting that Chinese response. All as Anthony Blinken heads to China, and a TikTok divestiture may be hitting Biden's desk as soon as today. More on that next. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
These two ships are from the Chinese Coast Guard. And the ship they're targeting with high-powered water cannons is a Philippine supply vessel.
We've been here for almost 3 hours, and the situation has gotten more tense.
An international court says the Philippines has the right to extract resources in these waters.
Since the threat has grown, we must do more to defend our territory.
China doesn't see it that way.
面对非方船只的强行冲闯，中国海警不得不采取必要的执法措施。
It's the 6th time in 8 months this kind of incident has happened, and it's a growing problem for the world. The U.S. and the Philippines have a mutual defense treaty dating back to 1951, and the circumstances that may trigger U.S. involvement have become more clear recently.
Southeast Asian leaders are anxious over the prospect of a war between the U.S. and China, two partners that they depend on dearly, whether it be over Taiwan or in the South China Sea.
Second Thomas Shoal is the most dangerous flashpoint today. This is truly a crisis waiting to happen.
China and the Philippines have wrangled over control of these waters for decades. But in the past year, tensions are close to the highest they've ever been.
Bloomberg Originals there, taking a closer look at the escalating tensions in the South China Sea. And just as we, of course, covered that geopolitical tension in that part of the world, we are getting lines out of the Chinese Foreign Ministry. Their daily briefing actually really targeting the EU. They're saying that this is, of course, coming from the spokesperson, urging the EU to stop smearing China, saying that claims of Chinese overcapacity are a, quote, protectionist excuse. And they hope that the EU abides by World Trade Organization rules, committing to that open market and stop trying to suppress those Chinese firms. So again, some very strong language coming out of China, targeted, of course, to the EU, given some of those rising tensions around the world with China and the rest. Let's talk about China in the context of the United States here. They're saying that the U.S. is, quote, sending the wrong signal after the Senate approved an $8 billion aid package for Taiwan as a part of the entire $95 billion national security package. It also comes as the U.S. Secretary of State Antony Blinken visits China this week. Bloomberg's Bill Ferry is, of course, in Singapore monitoring all of this. Bill, the timing here is really crucial because just as that potential TikTok divestiture bill hits Joe Biden's desk, Antony Blinken trying to be a good diplomat over in China. What could we see out of this meeting?
Well, yeah, you have Antony Blinken returning to China after Janet Yellen was just there and after U.S. and Chinese military leaders have finally resumed some communication. All of that talking going on between the two sides doesn't mean that the problems have gotten any easier. You mentioned the TikTok bill. There has been talk about the threat of new sanctions against Chinese banks who have been funding or buying oil from Iran. You've got continuing U.S. pressure on things like semiconductors and Chinese suppliers doing trade with Russia. So there's a whole range of really difficult issues that haven't gotten any easier. And I think it's likely that Blinken landing there after this TikTok bill probably gets signed by President Biden at some point this week. It's going to be some very difficult conversations he has with the Chinese. But compared to where we were, say, a year ago, when there were still difficult issues and no conversations, I think people on both sides are glad to at least have talks restarted.
Right, and so we find ourselves in this sort of dual track, don't we, Bill, as you point out. On the one hand, there are lots of visits happening and there's lots of interaction, and that's got to be a good thing. And Biden and Xi have met a couple of times since the balloon episode of a year or two ago. On the other hand, there are all these sticking points, and the detail is probably important there. Can we expect any breakthroughs in ties in the coming months?
I think major breakthroughs are unlikely. I mean, we're in particularly looking at the U.S. election calendar. I think the Chinese government knows that it's going to be a bumpy year. Anti-China sentiment is strong in both political parties in the U.S. It's one of the few things that unite them. So I think they're going to look for progress as they have more recently in kind of maybe less high-profile issues, but certainly, you know, the talks about the fentanyl trade, the precursors that are often manufactured in China that make their way to the U.S., working on things like that, working on climate change. But I think some of these really high-profile issues are going to be very difficult to resolve.
Bill, I thought was interesting in some of this kind of national security package. We talked about the TikTok a little bit, divestiture, but there was another piece in the Iranian sanctions, the broader Iranian sanctions, that talked about Chinese infrastructure, financial infrastructure, actively getting targeted as a part of the stricter enforcement mechanisms. How does that work? How's that being received in your part of the world?
Well, there's a lot of, there is concern about, the scope of these sanctions. They would, in theory, target Chinese banks or the financial system involved in the purchase and trade of Iranian oil. There is a political context to all this, though, of course, and that's the Biden administration doesn't want to see oil supply diminished. It doesn't want to see prices rise at the pump. So I think there is this built-in expectation that the President Biden, would use his authority to waive any restrictions, at least in the short term. I mean, we saw that bill make its way. There was no corresponding spike in energy prices, oil prices. So I think that is that's the bet the market is pricing in and that policymakers are pricing in for now.
Bill, thanks very much. Bill Ferry's there with the latest on US-China tensions and conversations that are set to take place with Anthony Blinken making his way to China, as we've said. What else are we watching for today? Well, 10:30 a.m. UK time, we'll see Germany auction 10-year bunds. That'll be 4 billion euros worth. 1 p.m. London time, ASML's AGM begins. We'll come back to that in just a moment. Rishi Sunak is going to be continuing his tour. He's been in Poland. He's going to be in Germany. Anthony Blinken arrives in China, as we were just discussing. And later, Christy, we get plenty of earnings coming through. Over in the United States, we have IBM, Boeing, Ford Motor Company, Meta Platforms. We've had some very outspoken commentary on Meta today from some of our guests, just at the top of this hour, in fact, talking about the extent of tolerance that exists for these businesses to spend money on moonshots, in the words of Alphabet, at least.
Yes, and Daniel O'Keefe specifically saying that this is money that he wished that the company would stop spending. Again, his words, not ours. I think what's also interesting is that this kind of meta story comes in line with the TikTok divestiture story in the States. Geopolitical tensions are kind of running through a lot of this, including for right here in Europe with ASML.
Yeah, absolutely. So let's focus in on that. ASML will hold its AGM today. The Dutch chip machine giant has grown into one of the tech industry's most critically important companies. CEO Peter Venning will pass on the baton to Christophe Fouquet after more than a decade at the helm and really growing this business, this big maker of lithography machines. But there are challenges ahead, not least US efforts to curb technology being sold to China. So let's delve into some of the detail that ASML is facing then. Bloomberg's Sarah Jacobs has details for us. Sarah, good morning. What legacy, let's deal with that. What legacy does Peter Venning leave behind then as he retires from ASML?
Good morning. Yes, in the over 10-year tenure of Peter Venning as CEO of ASML, the company's expanded to become Europe's most valuable technology company. ASML shares have risen nearly, 12,000% over this period. The company's, dominance in this sector can be attributed to its state-of-art extreme ultraviolet lithography systems, which it, launched in 2016. It's the only company that makes the equipment that's needed to, produce the most advanced chips that power everything from smartphones to, military technology. And just to remind you, these EUV machines are very expensive. They cost more than 200 million each. They're size of a bus, and their customers are everybody from TSMC to Samsung, who depend on their technology.
In terms of depending on that technology, it feels like ASML and, by extension, the Netherlands is kind of stuck between the two global superpowers of the world. You were alluding to that. I think about something like 30% of revenue comes from China for ASML. What is the new management or the successor? How might they deal with those tensions?
Yeah, so ASML has been caught in the crosshairs of the U.S. government's, push to block China's ambitions in the chip-making industry. The Biden administration pushed the Dutch government, or urged the Dutch government to introduce restrictions on ASML's, the exports of ASML's second most capable machinery to China, and that took effect on Jan 1st. ASML has never been permitted to sell its most advanced extreme ultraviolet lithography machines to China. So Fouquet, the successor of Peter Wenning, who will now come in, will have to navigate these sort of tensions between Washington, D.C. and Beijing, and while maintaining sales in its largest market, China.
And let me talk a little more about the identity of this business, I suppose, Sarah. ASML was considering expanding outside of the Netherlands, such a Dutch success story. But because of concerns around the business climate within the Netherlands, there had been some voices suggesting that maybe this business needed to grow elsewhere. What's the latest on that?
Yes, so ASML depends very heavily on international talent. The company sort of threatened to expand outside the Netherlands because of issues with, grid congestions there, because of the shrinking of the tax benefit for expatriates, workers, and proposals to stem the flow of international talent into international students into the Netherlands. So they've had all these issues, and the government sort of hastily put together a task force codenamed Beethoven earlier this year, where they tried to make sure the Netherlands the ASML remains within the Netherlands. And earlier this week, ASML came out and said that they had signed a letter of intent to, to explore the idea of expanding within their home region of Eindhoven. But of course, the final decision, they said, will depend on a lot of so-called crucial points which needed to be ironed out.
And we should make the point as well that this also comes in the backdrop of the Netherlands and the Dutch political parties really pushing back against immigration generally, which ASML, to your point, Sarah, has said they're really eating into how much they can expand in terms of actual talented labor. Bloomberg's Sarah Jacob, we thank you so much for bringing us that crucial context as well. Anna, that seems to be a theme around the world as well. Is where does the labor part of the equation factor into not just expansion for the likes of ASML, but the labor story in terms of the Fed, the ECB, et cetera?
Yeah, I mean, immigration, a hot political topic in many places, tight labor markets, a hot topic economically in many places, but using the former to fix the latter is politically difficult and challenging in some places. So certainly that is something that we have in focus. The chip story then, that rolls on. We've seen the influence of Texas Instruments. We're going to be keeping an eye on this AGM taking place at ASML. Other sectors in focus as well then today. Aviation in focus, because Guy has gone on his way to talk to Ryanair's CEO, Michael O'Leary. We'll leave the details of that for later, but we're going to bring that conversation to you a little bit later on today.
Yeah, talking a little bit about, again, where are the capacity shortages? Where are kind of the Boeing effect as well, I imagine will inevitably come up. And does that move the market in the way that, for example, some of those chip stocks were just moving? There's a lot to digest there when it comes to what is actually moving this market. Does the monetary policy matter? Or are we set? Have we kind of locked ourselves into a couple of weeks of micro earnings chat?
Yeah, I mean, we have that to look forward to.
Yes, we do.
If that is what floats our boats collectively, then we're in for a good time, because that is perhaps where the focus will be. But on the we won't lose sight of the macro, though, because, of course, we've got the BOJ coming up, and we have this ever-shifting landscape around Fed rate expectations, and what that does here in Europe, really interesting to watch.
And plenty of banks reporting tomorrow, which will kind of marry the macro and the micro. I guess that does it for markets today. The Pulse is up next. We're going to have some really interesting conversations. We were just talking about the airline space. The chip rally continues. All of that getting covered in the next hour. Stick with us. This is Bloomberg.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time. Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Tesla shines as it speeds up the plan for cheaper cars while investors overlook a big miss on earnings. Kering shares tumble after the luxury group warns profit will plunge as a crisis at its biggest brand, Gucci, deepens. Plus, President Biden says fresh U.S. military aid will start flowing to Ukraine within days after the Senate passes a long-delayed aid package. Now, good morning, everyone. First thing is first, we have some Germany April IFO Business Confidence Index, a bit better than expected, 89.4. The estimate was 88.8. Now, the other big story, of course, of the day is some of the European stock rally that we've seen yesterday, following, faltering a touch, actually. We've had some pretty mixed earnings. And this is, for example, from the banking world and the luxury sector, offset some of the further gains for technology stocks. So technology is doing quite well. We've had some U.S. tech giants. Certainly yesterday, we've seen weakness in measures of business activity for the world's largest economy, but that's also keeping alive forecasts for Fed policy easing this year. So I have to say the whole cross-asset is a little bit complex because there's always nuances to what the Fed does. The 10-year Treasury yield ticking higher, a gauge of the dollar was actually steady, but there was also this 2-year auction, which we look at very closely here on the Pulse, and that's actually went okay. 493.93 is where we're at, and you can see euro dollar 106.91. Now that IFO business confidence actually coming in a touch better than expected. 89.4 instead of the estimate 88.8. And then the big story among some of the corporates and some of the earnings is Tesla. Pre-market, we're just getting that, of course, open, and it's gaining some 12% pre-market. We did also have a great Bloomberg story on Monday that really hit the nail on the head on exactly what we thought, and our reporters on the ground thought Tesla would do. So we had much more of an insight from Elon Musk yesterday as they reported earnings. So for actually a lot more on Tesla, getting some 12%. So let's get straight to our auto czar. He's Craig Trudell. He oversees automakers across the globe for us. So Craig, thank you so much for joining us. First of all, I mean, Bloomberg and, under your team and your leadership basically did this wonderful story, The Big Take, that kind of had understood that what Elon Musk wanted to try and do is get some really cool, engines and put them in their best-selling models. Is that what we found out yesterday?
Yeah, so to kind of go back, this company got everybody excited about this idea of a $25,000 car late next year.
Yeah.
Then kind of freaked everybody out by giving every indication that that was actually not the plan. Last night, Musk gave every indication that Ed Ludlow and Dana Hull's reporting that what they're going to do is take some of the development work toward what was going to be that $25,000 car and apply it to their existing lineup. And that means getting cheaper cars to market faster, de-risking that plan a little bit. It's less CapEx intensive. And, whenever you bring entirely new cars to market, it's a high-risk proposition. It means you're probably going to have to take some downtime he gave every indication last night that they're going to take this sort of go-between strategy to get something to market, maybe even as soon as late this year.
And Craig, the fact is that actually analysts like the fact that Tesla is trying to accelerate the launch of this less expensive cars, right, because they really disappointed in the previous quarter. Let's listen to what Elon Musk had to say on the call with analysts.
We've updated our future vehicle lineup to accelerate the launch of new models ahead of previously mentioned start of production in the second half of 2025. So we expect it to be more like the early 2025, if not late this year. These new vehicles, including more affordable models, will use aspects of the next generation platform, as well as aspects of our current platforms, and will be able to be produced on the same manufacturing lines as our current vehicle lineup.
Again, on the back of that, so Tesla's up quite significantly, pre-market because of the speedier rollout. Is there are you worried that he disappoints on the timing of it?
I think we do have to be really careful in that Elon time is not always actual time, right? So he often sort of overpromises and underdelivers. But I do think that, it does make some sense after the absolute battering that the stock has taken, particularly just in the last few weeks, that this plan to bring cheaper cars to market, gives people a little bit more confidence with this idea of, okay, maybe this is a company that can grow again. And I think his outlook for the year is referring to the idea that he does expect to sell more electric cars this year than last year, also put people at ease because people started to have real doubts after the rough first quarter that they had.
So, Craig, what are you watching for next? Again, this lower price car could certainly help sales. Do you watch for the first sale or actually the first making of the car?
I think we need indications that optimism about sales going up this year is actually warranted because for all of the happy talk and the excitement about last night's call, the earnings were abysmal. They had more than $2.5 billion in negative free cash flow. That's the most ever. Revenue came short of estimates. Earnings came short of estimates. So under the hood, the company is not performing well.
Okay, Craig, thank you so much. Always interesting, Tesla. There's always some surprise around the corner. Pre-market getting some 12% for Tesla. Bloomberg's Craig Trudell there. Now, we also had some latest German IFO Business Confidence Index rising more than economists had expected in April. Now, I'm delighted to be joined by Clemens Fuest. He's the president of the IFO Institute. Mr. Fuest, as always, thank you so much for talking to us. Now, the Bundesbank actually thinks that the economy probably grew in the first quarter. Germany, once again, would be dodging a recession in that scenario. Are you confident that the turnaround is now here for good?
Well, I think the first quarter didn't go great, but what we now see is an improvement, yes. And in a way, it's a divided improvement. It's mostly coming from services. We also see good data from retail. In industry, in contrast, the situation is bad and continues to be bad. So manufacturing companies are telling us they are lacking orders. Construction is also flat, not going well. But at least we have this positive impact of more consumption, and that helps.
Yeah, so I was going to say, actually, consumers, I guess, have been for a long time expected to drive the recovery, but have been quite hesitant. With this renewed optimism that you have on consumption, are you confident that that will pick up, that that's really turned a corner?
But it looks like it's picking up. We had expected it to pick up earlier, but this is something that may lead us to growth in the second quarter, I would say. I think for the first quarter, that won't help anymore, but for the second quarter, I'm more optimistic. And it's consumers that are driving this. Incomes are rising more quickly than inflation because inflation is going down. So what we've been waiting for, in a way, it looks like it's coming.
There's quite a difference between services and manufacturing. So manufacturing weak, services doing quite well. Do you expect to catch up soon?
At some point, yes, but we don't see this catch up. We see an improving worldwide economy, but this doesn't seem to reach German manufacturing, which is puzzling in a way. Of course, there are issues in Germany, high taxes, concerns about protectionism. A lot of German companies are investing, but they are investing abroad, not in Germany, because they want to be present in markets and maybe jump over protectionism and tariffs and produce closer to consumers, this is no good news for Germany as a location for manufacturing firms, and we don't see the recovery there yet. It'll hopefully be coming, but that may take some time.
Mr. Fust, overall, Germany is still performing, much worse, or at least worse than other European countries. Is there still a chance that this economy catches up?
I think what we're seeing at the moment confirms the forecasts, which are saying the growth will be weak in Germany, but at least it won't be negative. So this is the stabilization we expected. It's not a complete recovery, but at least it's a start.
What's your take on geopolitics right now? I know it's the impossible question to answer, but how much will that weigh on German growth?
I think it's one of the factors really weighing on German growth, because Germany is an exporter, and exporting is getting more difficult, and that's why we see companies investing more in what used to be the destination of German exports. So that's investment in the US. That really is an issue. At the same time, Germany is trying, despite the tensions, Germany is trying to maintain trade relations. Chancellor Scholz just traveled to China, and there were a lot of people from companies, from industry accompanying him. He's been criticized for that, because people say we need to de-risk in China, but at the same time, I think it does make sense for Germany to try and maintain trade relations, and that's what's going on. Unfortunately, new trade agreements, for instance, with Mercosur, are slow, and that's another problem for the German economy. Germany has a strong interest to come to new trade agreements, and that's going very slow at the EU level. So what will happen there, whether we in the end do achieve these trade agreements, will be very important, especially for German companies.
And Mr. Fust, how much do you worry about inflation picking up again? So the ECB not cutting rates and that weighing on the economy?
I don't expect the ECB to maintain rates. I really expect them to cut rates. Yes, there may be pressures coming from the service sector because wages are rising, but at the same time, the economy overall in the Eurozone is not strong enough, in my view, to produce another increase in inflation. That would be different if there was another crisis in the Middle East, for instance, and oil prices were rising. But as long as that doesn't happen, I think there is no danger that the ECB will call off the interest rate cuts everybody's expecting. So I think that will come, and I do think inflation will continue to go down.
Okay, Mr. Fust, thank you so much for joining us today. That was Clemens Fust, the president of the IFO Institute. Now, coming up, we also take a closer look at how mega cap earnings are driving market sentiment with Goldman Sachs senior strategist Sharon Bell. That's next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, European stocks steady as a rally in tech stocks was offset by a post-earnings pullback in carrying and luxury stocks. Let's get more from Goldman Sachs senior strategist Sharon Bell. Sharon, thank you so much for joining us. I mean, you're always so good at putting together all these different strands of some of the market pressures, some of what will support valuations. A lot of it is now in the companies, but we can't also forget the macro.
Yeah.
So your research at the moment is focusing really on different valuations depending on the region you're in.
Yeah, I mean, we feel that the gap in valuation between the US and Europe, which has always existed, and the US equity market's more expensive, it's performed extremely well in the last decade, really, very consistently, but the gap in valuation between the two is very large at the moment. And as we heard just now, the IFO survey has been a little bit better in Germany. Some of that data is improving very, very modestly, and that should help not close the gap, far from it, but certainly narrow it a little bit.
But I was looking at some research, like if you look at S&P, earnings expectations, they just keep on rising. Like, is there an end to how much some of these companies can grow?
I think that US is growing fast. I totally agree. And you see that for the economy. You're probably going to get first quarter GDP around 3%. So fast pace of growth, whereas in Europe, we'll be lucky to get above zero. Hopefully it will be above zero in the first quarter. But I guess it's a case of what's in the price. And already US companies are highly valued for that growth. And I would say if you look at earnings growth year on year, it is decelerating compared to where we were at the very end of last year for US stocks.
Do you worry that the markets are discounting any kind of geopolitics event because of inflation that could even force ECB not to, or do one cut and then be done?
Yes, I mean, I think everyone has pushed out their expectations for when the Fed might start cutting rates. We have ourselves a little bit, and there is of course a risk that they don't even cut this year. Some people have even discussed a hike, not our view. So, of course, I think from an equity perspective, it's not for all bad reasons. It's because growth has been good, largely, but also inflation has been a bit sticky. And to your point, as well as inflation being sticky because of higher wages and higher services spend, etc., you've also got the additional issue that if commodity prices have been rising because of geopolitical risk or supply constraints, that gives us another kick to inflation, which won't be helpful either. But I feel in Europe, the disinflationary trend from very low growth that we've had in the last few quarters is still very much there. Gas prices have risen, but they're still so far from their peak. The storage levels are good, etc. Europe shouldn't have the crisis that it did last time.
I mean, there's a couple of market movements that, again, we're trying to get our head around, like what's happening with gold, which is just behaving differently to everything it's done in the past. Is there something, I mean, is this a play on liquidity? Is it, something else in the market?
I mean, we think that there's a lot of reasons why people want to diversify their exposure, let's say, and gold is a nice asset to diversify to. You mentioned geopolitical risk, which is almost top of mind for every investor that I speak to. It's one of the first things they talk about. So you're worried about geopolitical risk, gold is seen as a bit of a hedge. So are maybe commodities and other assets like the dollar, which has also been doing well. So gold, I think, is one beneficiary of that. But also, I think you've started to see more central bank buying of gold. You've seen more buying generally of gold as people are worried about maybe sanctions, maybe geopolitical risk, maybe too much exposure to the dollar. Lots of reasons, I think, that people wanted to diversify away from just one, I want to say risk-free asset, but one asset provides you a little bit of a hedge against some of these global risks.
Amongst your notes, and I love some of the strategy, reports that you put out. So you say, buyback bonanza, yields are returning, and it's very clear that it's bank and some of the energy stocks that have been giving back dividends. I mean, is this, how do you play those sectors that just have been very, very good to investors?
Well, this is in some ways this argument again of the gap between the US and Europe. Yeah. Many European companies are super cheap. They are super cheap, so much so that these companies making good earnings, like the energy stocks or the banks, are saying, we're making good earnings, good cash flow, we are super cheap, we don't have a very stretched balance sheet. You know what we're going to do? We're going to buy back shares. They've been buying back shares, and actually our basket of companies which buy back shares the most has been doing super well. So I do think I think this lots of people have been concentrated in, say, the Magnificent Seven, the big cap tech stocks in the US, and they have done really well, and they've got the growth story, as you point out. But I think there are other stories out there too, including the fact that European companies for many years didn't do buybacks, and now saying, actually, with this excess cash, we know our stock is cheap, we're going to buy back our shares.
I mean, luxury did extremely well in Europe, and you have some big players, and now it's getting I guess, repriced. I mean, is this a wider concern for the sector?
I would say with luxury that it's been very mixed. There have been some real losers there. There have been companies that maybe they're losing market share, is my feel, rather than you're seeing a collapse in demand generally for luxury. I mean, we know the wealth of the highest income, wealthiest globally has actually been reasonably strong over this last year. You see this in asset prices doing very well, as you point out. So to us, you're not seeing luxury demand collapse. It's more reshaping of who's doing well and who's doing less well. Also, the Chinese traveller is definitely around. Yeah. They're travelling again, and they buy lots of luxury products. You're not necessarily seeing them buy in China itself, but you can see them buy in the rest of Asia in particular. So to us, actually, it's more that rather than a wholesale decline in luxury demand.
So interesting, Sharon. Thank you so much. Sharon Bell from Goldman Sachs stays with us, and we'll talk a little bit maybe about dollar dynamics next. This is Bloomberg.
This is Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to The Pulse, everyone. Now we're back with Sharon Bell, Goldman Sachs senior strategist. Sharon, thank you so much for sticking around. We're talking about some of the earnings, some of where you see the biggest value in terms of industry groups. Now, how problematic is stronger dollar for the rest of the world?
I think for Europe, if I'm thinking about European equities and earnings, actually the stronger dollar is a good thing. A lot of European companies are dollar earners. And a stronger dollar means when they translate that back into euros or sterling, actually, it looks quite good. So a stronger dollar is definitely not unhealthy for European companies' earnings. If anything, I would see it as a bit of a tailwind for them. That being said, you've got to also think about the reasons for the stronger dollar. To the extent that it's stronger US economic growth, that's fine, obviously, for the rest of the world, because you benefit from that stronger growth. Lots of companies sell into the US. But to the extent the stronger dollar is because of geopolitical risks or some other constraint, then absolutely that's not such a good thing for the rest of the world. And I think it's a little bit mixed at the moment.
Okay, so I mean, I know it's impossible to quantify, but is it like 20% because of geopolitics and the rest because of the stronger economy? Because there's also a worry that actually the U.S. economy is overheating.
Yeah, I guess also that pushing out of the Fed, so rate expectations as well, all of those things pushing up the dollar. So it's a little bit of a mixed bag, but on balance, and particularly for earnings, I would say for European companies as well, that reporting euros and sterling is actually going to be a bit of a tailwind.
Sharon, I have a million questions on AI, what will drive our economies, on the price of oil, on China. What's the question that you think is more important right now that investors need to ask themselves?
Oh, that's a great question. Look, I think, again, if I'm thinking about European equities, I would say whether we actually genuinely get a turn in growth. And I link this back to the conversation you just had on the EFO data. Yeah. We have seen that improve, which is fantastic. And the PMIs that we had yesterday also showed improvement, but they were mixed. Yeah. The manufacturing side of the economy is still super weak. The services and consumer side, absolutely clear from the data that is improving as inflation comes down and real incomes improve and employment is good. So that's great. But will we see that movement up in manufacturing broaden out? Yes, the US economy has been strong, but most other places have been weak. So broadening of growth and particularly toward manufacturing is important.
So good. Thank you so much, Sharon. Sharon Belder, Goldman Sachs senior strategist. Now, coming up, President Biden is expected to sign a long-delayed aid package into law today, clearing the way for resumed weapons shipments to Ukraine, actually this week. Details next, and this is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Tesla soars pre-market as it speeds up the plan for cheaper cars. Investors overlook a big miss on earnings. Well, Kering shares tumble after the luxury group warns profit will plunge as a crisis at its biggest brand, Gucci, deepens. Plus, President Biden says fresh U.S. military aid will start flowing to Ukraine within days after the Senate passes a long-delayed aid package. Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua here in London. Now, we had a terrific debrief by Craig Trudell on exactly what's going on in Tesla. I would suggest everyone go back and read also our big take from Monday. That was kind of spot on what Elon Musk was trying to do. Now, Tesla soaring almost 11% pre-market after pledging to speed up the launch of their more affordable models. Again, the first quarter profit and sales actually missed, but the EV maker plans to release the cheaper cars as soon as this year. And that's frankly well ahead of its previous late 2025 timing. This actually gave a lot of optimism to analysts out there. You can see Tesla gaining 10.3%. Now, a couple of other things we're watching out for is some of the banks. We were hearing there from Sharon Bell, of course, from Goldman Sachs, that this is one of the things that they're looking for and they're looking at in how much banks are also giving back to shareholders. So if you look at the equity complex here in Europe, it's definitely banks and energy that have been quite cash rich and have been able to give back probably the most. Now, some breaking news we have also from UBS just coming out on the Bloomberg terminal. UBS saying they are seriously concerned about some of the Swiss capital proposals. Now, we have been bringing you up to date with the fact that the S&B has raised the requirement reserves for banks to reduce payouts. Now, this happened a couple of days ago, so this is actually the first time that UBS is coming out with a statement on these new capital proposals saying that they're seriously concerned. So we'll continue looking at this very, very closely. It was just a couple of days ago that the S&B said they would require banks to hold more money at the institution. Again, a move that will cut how much interest it actually pays to them. Onto politics, and the U.S. President Joe Biden is expected to sign a long-delayed $95 billion emergency aid package for Ukraine, Israel, and Taiwan into law as soon as today. It clears the way for resumed shipments of weapons to Ukraine this week. Now let's get more from our Bloomberg Markets Today anchor, Kriti Gupta. So, Kriti, I mean, this was, very welcome news, certainly from Europe. What can Ukraine expect in terms of actual shipments?
Yeah, let's talk about kind of where the money actually goes here. A lot of this is air defense systems, and this is really important in terms of drone warfare. We cover that quite a bit in terms of what's going on in terms of ground day-to-day movements between Ukrainian and Russian forces. So about $14 billion out of the 61 total is going just those U.S. defense systems. So the idea here simply being kind of the machinery that detects those attacks, radar systems, et cetera. Then you have about $13 billion going to actual stockpile replenishments. That's ammunition, that's firearms, et cetera. $7 billion for about U.S. operations there. And then I think the key part here is the $9.5 billion in forgivable loans. And this is crucial because this was originally a President Trump kind of idea that was then tacked onto this bill. The idea here simply being that ultimately this is a more economic assistance as opposed to defense assistance that would go in other places of the Ukrainian economy. The assumption here is that if President Biden comes to his second term, he will forgive those loans. If President Trump does, they will not.
So there was quite a lot in the bill, including sanctions against, Iran. What are the implications of those?
Yeah, the broader sanctions are interesting here because there have been sanctions on Iran for a very long time. And a lot of people have said it's not about the sanctions, it's about the enforcement of the sanctions. And that's where the nitty gritty of the fine print really comes in handy, because this isn't just oil or ports or vessels or even kind of the refineries that Iran operates. It's the infrastructure, the financial infrastructure, a lot of which is kind of built and operated by the Chinese that is getting targeted. Now, in terms of the actual oil price here, I think that's what everyone wants to hear. It's that geopolitical premium. People are saying about $2 to $3 a barrel. That's the call, at least from Eurasia Group, added on to about $90 a barrel. If, big if there, the stricter enforcement actually comes through. Javier Blosser, Bloomberg Opinion, saying that that's been an issue for a while, and he'd be surprised if it actually did.
And then TikTok feeling the fury of the U.S.
Yes, even more China's read-through. Again, you can kind of see a theme in all of this show up. The divestiture has been on the kind of playbook and on the agenda for a very long time. Now that's getting signed into law, there's a very long legal battle ahead of us. Remember the last couple of years, we've had TikTok removed from the App Store, removed from the Android, then brought back on because of those kind of competition questions as well. Now TikTok, ByteDance by extension, really gearing up for a long legal battle, kind of putting their boxing gloves on, saying this is not only unfair to Chinese businesses, but ultimately unconstitutional because so many people, even Americans, have been lobbying for easier access on TikTok, given it's a way to actually make money for things like influencers, for example.
Yeah, it was, I mean, such a great roundup of a very important bill. Thank you so much, Kriti Gupta, there at Bloomberg Markets Today anchor. Now, this was supposed to be the year that Vietnam reaped the benefits from its largest natural gas discovery in the South China Sea. On the other side of the disputed waters, the Philippines has long eyed the energy riches off its northern coast as a way to reduce its reliance on imported gas and oil. But neither country has benefited as Beijing continues to claim the territory and tensions rise.
These two ships are from the Chinese Coast Guard. And the ship they're targeting with high-powered water cannons is a Philippine supply vessel.
We've been here for almost 3 hours, and the situation has gotten more tense.
An international court says the Philippines has the right to extract resources in these waters.
Since the threat has grown, we must do more to defend our territory.
China doesn't see it that way.
面对非方船只的强行冲闯，中国海警不得不采取必要的执法措施。
It's the sixth time in 8 months this kind of incident has happened, and it's a growing problem for the world. The U.S. and the Philippines have a mutual defense treaty dating back to 1951, and the circumstances that may trigger U.S. involvement have become more clear recently.
Southeast Asian leaders are anxious over the prospect of a war between the U.S. and China, two partners that they depend on dearly, whether it be over Taiwan or in the South China Sea.
Second Thomas Shoal is the most dangerous flashpoint today. This is truly a crisis waiting to happen.
China and the Philippines have wrangled over control of these waters for decades. But in the past year, tensions are close to the highest they've ever been.
Well, Bloomberg Originals are taking a closer look at the escalating tensions in the South China Sea. It's also the topic of today's Big Take. Now, the South China Sea and global defense more broadly is high on the agenda as the U.S. Secretary of State, Antony Blinken, travels to China today. So let's bring in Bloomberg's news director for the EMEA region, Rosalind Matheson. Ros, I'm really happy to speak to you today because there's a lot of big but also little concerns around the world, and I don't know whether there's a common thread. Is the common thread just more risk appetite for geopolitics, or is it China trying to influence corners that in the past they hadn't?
Well, the common thread really is that we're moving from a world where the US was the single dominant power globally to a multipolar world where you've got not just China but Russia, you've got middle powers in the Middle East rising, you've even got countries like South Africa suddenly more assertive in foreign policy. And so it's a long-running trend that we're seeing where the US arguably is retrenching in certain parts of the world, and that's bringing tensions, as is the case between the US and China particularly. And the tensions in the South China Sea, they've been bubbling for decades, but what's happened is that China has really had the advantage, and now we're seeing that bear fruit. So many, many years ago, China started repurposing these reefs, these shoals in the South China Sea, and turning them essentially into military bases, using their coast Coast Guard. They've been using their Coast Guard to scuffle with the Vietnamese and the Philippine military for years now, but it's really escalating to the point where they're stopping these countries around energy resources in the region. They're sort of essentially changing the status quo in the South China Sea. And that's part of the broader thing that we're seeing globally, again, with different countries emerging as powers, and the US, some would argue, in decline.
So, Roz, when you look at the, non-friendly U.S. countries, so I'm thinking of Iran, Russia, China, are they biding their time in case Trump comes in the White House, or do they have a window of opportunity to kind of, inflict, chaos or doubts from now until the U.S. election?
Well, you can see on the part of the US administration that Joe Biden is trying to bake stuff in now in terms of law and behavior, just in case it is another Donald Trump administration. You can see countries like in Europe and elsewhere preparing for that eventuality. You talk about the future of NATO, for example, and that's going to be very uncertain if Donald Trump comes back to the White House. But you can also see that China likes to play both the short and the long game. So you've got a short game going, which is to get themselves in the best position for a future US presidency, be it Joe Biden again or Donald Trump. But China, like Russia and others, arguably play the long game too. China's thinking in a 10, 20, 30-year horizon about where they see themselves economically, strategically, geostrategically in the region. And they're looking through the US administrations in a way beyond who's just in power in that minute, what's their long-term goal. And that's the way the US, in turn, probably needs to be viewing its behavior with China.
What's your take on Ukraine right now? With this extra help and the extra bill, even if we have, help that comes this week, can they really longer term win the war?
Well, that's the big question. I mean, obviously, any military aid is useful and important, however late it comes, and some is really needed, from everything from ammunition to artillery to air defense, and that's also coming. It could come pretty quickly at this point, but it's at a point where Ukraine needs to regain momentum, and that's always difficult when you're behind and you need to recover, and Russia's got the momentum at the moment. And then beyond this aid package, anything further is going to be very, very difficult given the political climate in the US. So if this was hard enough, imagine further big packages getting stuck in Congress forever. And Donald Trump, again, if he wins the election, he's made clear he doesn't see the need to continue to supply Ukraine with aid. So this may help Ukraine in the short term, but in the longer term, there's big questions about where this war is going.
Ros, thank you so much, as always, for really terrific insight. Rosalind Matheson there. Now, coming up, we talk luxury, and Kering shares hit a 6-year low after first half profit warning as Gucci sales falter. We'll talk luxury next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Well, the next episode of Leaders with Lacqua is an extremely rare interview with the chief executive of Chanel, one of the most exclusive luxury brands in the world. The chief executive, Lina Nair, spent decades at Unilever before switching from the world fast-moving consumer goods to haute couture and beauty. Now, she spoke to us about the company's plans to continue investing in China and the strategy behind recent price hikes.
So we raise our prices according to the inflation that we see. So they're really linked to the cost price. We've also made a commitment to price harmonization across the world, which means our client should not experience excessive price differentials, no matter where they buy.
And how do you see the China market right now compared to the U.S. market? Because it's not that volatile, actually. You kind of have like a base that stays for quite some time.
China is a very essential market for the luxury ecosystem because of the fast adoption of luxury, because of the appreciation of refinement and sophistication. So it's a very important and essential market for us. I came back recently from China and I was really happy to see the energy and vibrancy in the market. So we continue to run our business for the long term and continue to invest in China for the long term.
And you can see that full interview with the Chanel chief executive on Leaders with Lacqua at 9:30 p.m. this evening in New York. It premieres at that time, and then tomorrow, 6:30 p.m. in London. Now on to more luxury and Kering, warning that profit will plunge in the first half of the year after wealthy shoppers curbed spending on Gucci products. Now, comparable sales at Gucci actually tumbled 18% in the first quarter on slower demand in China. Well, joining us now is Andrea Felstead from Bloomberg Opinion. Andrea, you have the pulse, of course, of the luxury world. So are other companies going to be concerned about what's happening at Gucci, or is it just a Gucci problem for Kering?
I think it's a bit of both. I think this is largely Gucci focused. Gucci burned bright for a long time and then went out of fashion, and Kering is really struggling to get that momentum back. Saying that, there are some read across perhaps for those brands like Gucci that are in a turnaround phase, such as Burberry.
I mean, I guess the concern is that Gucci is such a high percentage of the sales for Kering. Is it similar to what Louis Vuitton is for LVMH?
Yes, indeed. It's they're both key brands for the two groups, and I would say Kering is particularly dominated by Gucci. Yeah. Their other houses aren't big enough to change the fortune.
So what's the secret sauce of being so big and still so successful? I mean, Alessandro Michele, with his vision of like opulence, and there was gold and there was velvet, and it kind of went back to the archives, did really well for a moment, and then it kind of went on to quiet luxury, and so people lost interest. I mean, how do you do that?
It doesn't matter what the prevailing look is at the time. It's all about brand desirability. If you can, really encourage people to just really want the products, they're prepared to eat beans on toast for a month so that they can buy that handbag. That's the secret.
So you said handbag, and I was wondering actually whether leather goods are easier to sell, especially in a downturn, than clothes.
That was always the theory, that leather goods were more resilient than other products. But I'm not sure that is still the case, given the price hikes that we've had. The theory is that, products, maybe jewellery, is attractive at the moment because leather goods have gone up so much. Rather than buy a handbag, perhaps you buy a Cartier bracelet or a Van Cleef necklace. So that theory is really being tested this time round.
Andrea, as always, thank you so much for joining us. Andrea Felstead there from Bloomberg Opinion. Coming up, Boeing prepares to release earnings with analysts watching for cash outflow in the wake of its MAX 7 crisis. More on that next, and this is Bloomberg.
top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Now, Boeing's cash outflows will be in focus when it reports earnings later today. The plane maker is engulfed in a crisis involving its main source of revenue, the 737 MAX. So for more on all of this, let's get straight to Bloomberg's Charlotte Ryan. Charlotte, so good to see you on TV. So investors, what are investors looking out for in these results?
Yeah, so in focus from the investor side, obviously the numbers. We're expecting the company to make a loss given everything that's been going on and the fact that they've had a cap on their production from the regulator, which is obviously limiting how many planes they can get out the door. On the cash burn side, they're expected to burn somewhere between 4 and 4.5 billion. So anything over that, obviously bad news. It's from the analysts I've spoken to, it's expected to be over rather than under, again, given everything going on. And then the other key thing will just be any kind of guidance about where Boeing goes from here. You know, how long do they expect that cap on production to last? Where are they in the search for the new CEO? A lot of different things going on at the moment, so there will be plenty for investors to ask them about.
What have actually regulators done so far?
Yeah, so the regulators have been pretty active on this one. I think the FAA is kind of anxious to shake off that reputation of being a bit too cozy with Boeing that they've been accused of in the past. So they've imposed this production cap that means Boeing can't go above 38 737 MAXs a month. And they've not really given any timeline for lifting that. That's kind of to be decided. And then they've also, at the end of February, given Boeing 90 days to sort out its quality control lapses. That deadline coming up at the end of May. What's not clear is what happens if they haven't sorted things by then. But there's definitely kind of a sense of a more active regulator that is stepping in with this company.
And then, I mean, is there anything that Boeing can, at this point, can do to address the issue? They've done quite a lot. There's a change in leadership, but not until later this year.
Yeah, so they have made some big moves. They've changed the leadership. The CEO is not leaving until the end of the year, but they have already changed the head of the commercial aircraft business. And what we're hearing from airlines is that's been seen as quite a positive change. So that's something, that seems to have gone well so far. But other than that, it's just about kind of showing, the market, showing regulators, showing customers and people who are going to get on these planes that you're taking this seriously, you're taking steps to change things. So I think a lot of it will be about that.
Thank you so much, Charlotte Ryan, there with the very latest on Boeing. Now, don't miss our interview, actually, with the chief executive of Airbus, Guillaume Faury, tomorrow. And then in the next hour, we'll also hear from the chief executive of Ryanair, Michael O'Leary. So earnings season well underway with Meta, another magnificent 7 mega cap due to report later today. Now, the company's generative AI tools are expected to continue strengthening its positioning. Let's get more with Bloomberg's Alex Webb. Alex, we had Tesla yesterday, and there's a lot more coming up. So what are you focused on?
Well, Meta's really interesting because the expectations actually of Meta are remarkably high. They had their year of efficiency. They have therefore reduced costs a lot. They did lay off quite a lot of people. There also seems to be a focus on their AI, not just in the generative sense, but they have a lot of people working in AI. People are realizing actually those people are often working on the ads product, and that ads product seems to be doing quite well. Excuse me, the street's looking for something like a 50% increase in operating profit and a 26% increase in revenue. That's sort of numbers that we're used to from Facebook a few years ago. People didn't necessarily think that that was going to be the case again. So there's a lot of optimism. That, of course, does mean that if there's any missing of those numbers, then they could be punished, given the way the stock has risen this year.
So who's more interesting, Meta or IBM?
I mean, they're usually more interesting, but look, IBM is interesting in a different sense because it is more sort of in the weeds of what other companies are doing in particularly AI. Like if they are taking on some of IBM's tools, helping their businesses migrate to cloud-based AI. IBM is a company that they could be using to do that. So we've seen a lot of the investment in AI tools in the cloud from the big hyperscalers, the Microsofts, Googles, Amazons of the world. There might be some indication from IBM of whether those tools are starting to be used because they hire IBM to make it happen.
What will happen to TikTok?
The jury is quite literally, but almost literally out, because now it will come down to the courts, right? Yeah. There is going to be a big appeal from TikTok. It's largely expected to be on the basis of free speech, on First Amendment rights. It looks as though some meaningful American bodies may get behind TikTok on this, including the ACLU. That's been mooted as a potential ally in this case because they think it might be a restriction on free speech. Nonetheless, it has passed the House, it has passed the Senate, this bill, of which TikTok was just a small part, but a significant part. And now it looks as though President Biden is going to sign it into law. It'll be 270 days from that happening to ByteDance, the parent company, having to either sell or either divest or withdraw the business from the US. I think the big question is whether, if there is a court case, there will be a stay on that, or whether they'll have to do it, have to pull out defensively. I think most likely it'll be a stay, and it could be a number of years until we reach a conclusion.
Alex, thanks so much. Alex Webb with the very latest on some of these magnificent 7 companies, and of course TikTok. Now, Tesla shares jumping as much as 11% in pre-market trading. This is after what Elon Musk said yesterday. This is Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. So how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. and all those skill sets that they've built. To me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning from our world headquarters in New York. I'm Menace Cranny with Denny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Tesla soars on the promise of making cheaper cars sooner. Meta takes the spotlight after the close. More earnings. Boeing's cash burn will be in focus when results drop before the open. And the Senate passes the $95 billion aid package, clearing the way for fresh arms shipments to Ukraine within days.
Danny, everybody loves a comeback story. Everybody likes the sound of what they heard from Elon Musk yesterday. The stock is up 10%. Or is it those people who believe in autonomous driving? Because it basically had a message. The stock is up over 10% this morning, 51.14. More Mag 7 to come through. The Mag 7, magnificent turnaround yesterday. But there was a message from Elon Musk, and we'll talk more about it in a moment. If you don't believe in my vision of autonomous driving, don't bother owning my stock. 2-year yields, they bought. The bid to cover ratio was nice on the bonds. We've got 5s and 7s coming today. They lapped up the 2s yesterday. Bank of America were with me yesterday. They said, lean into duration wherever you are. However, there are cracks in the ISM that we saw yesterday, and that helped cheapen the yields up. Dollar yen, get ready for intervention. We've had a very, very senior former Vice Minister of Finance, Furusawa, say we're close to intervention, along with Suzuki, the finance minister. So intervention is on a watch as we hit a fresh 34-year low on dollar yen. Danny, good morning.
Interventions talk, but still lower on the yen. That seems to be the trend. Manage quickly, we have some breaking lines coming through. We have a new April Bloomberg News morning consult poll. It has found that President Biden is ahead in just one of the 7 swing states, that one being Michigan, by 2 percentage points. Biden also trails Donald Trump slightly in Pennsylvania and Wisconsin, but his deficit menace in Georgia, Arizona, Nevada, and North Carolina is larger. And I found it interesting when you ask about the economy, when you ask about inflation, more than 50% of swing state voters think it'll be worse by year end.
Well, this is where Bidenomics is now very, very clearly equated. 3/4 see Bidenomics being responsible for inflation. 50% see it being very responsible for the state of the economy. The other thing that comes through in this morning consult poll is that Trump leads in the head-to-head matchup with Biden in 6.
Yep.
You know, there's let's say that State of the Union bump that Joe Biden had seems to be dissipating ever so slightly.
Yeah, certainly is. Well, a lot has been on the agenda since then, from global geopolitics to Israel to the economy. And we're going to talk about that in just a few moments with our Anne-Marie Horder and Manus.
Indeed. I mentioned everybody loves a turnaround story, and Tesla did that. It snapped 7 days of losses, extending its post-earnings rally as the EV maker announces plans to speed the launch of cheaper cars.
We've updated our future vehicle lineup to accelerate the launch of new models ahead of previously mentioned start of production in the second half of 2025. So we expect it to be more like the early 2025, if not late this year. These new vehicles, including more affordable models, will use aspects of the next generation platform, as well as aspects of our current platforms, and will be able to be produced on the same manufacturing lines as our current vehicle lineup.
Well, let's bring in our global autos editor, Craig Trudell, for more. Craig, are you surprised? I mean, it was quite a turnaround, just how positively the market took this report, given the dissipation in gross margin.
Yeah, I mean, really everywhere you looked on the earnings results, things were not looking good and came short of expectations. I think if folks were closely reading our very own Ed Ludlow and Dana Hull earlier this week, they would have seen that this was the plan, that what Tesla was going to do was take some of the work that they were doing on this next generation vehicle that they've been referring to as coming late next year and apply them to existing models, and particular emphasis on the Model Y. That was in our big take at the beginning of the week. I think the only reason that Musk didn't, quite, confirm that just outright is he can't say at this juncture that, the Model Y and the Model 3 are going to get cheaper, perhaps even by the end of this year, because that may just lead more consumers to potentially hold off on buying and kind of wait for prices to bottom out on those cars.
That's a good point, Craig, and maybe one of the reasons of many he didn't give many details. If you look at what Musk did say, Manus mentioned this quote, if someone does not believe Tesla will solve autonomy, they should not be investing in the company. Instead of giving details about cheaper cars, he talked about autonomy, he talked about AI, he talked about robotics, he talked about his robo-taxi. Craig, it seems like he didn't want to actually talk about the outlook for cheaper vehicles.
No, absolutely right, and everyone's been freaking out about this, $25,000 car that they said was going to come, potentially as soon as late next year. I think, I didn't hear anything last night to sort of dissuade me from concluding that is still called off. The reports of the last few weeks that has everybody, panicking in the lead up to this call, those are all valid, and yet it does seem like the market, heard enough to get excited about this idea of, well, there is at least a plan, in the interim to sort of reinvigorate growth, even if it's with the existing lineup.
Right, of course, we're not going to get that until, as Musk says, at least the fourth quarter. And oh, by the way, they have to do the robo-taxi thing before that. So I think we're going to be waiting a while. Craig, thank you so much. Craig Trudell. Joining us now is Richard Claude, Technology Portfolio Manager at Janus Henderson. Richard, thanks so much for joining us this morning. Good morning to you. So if we look at the reality of Tesla, it is falling sales despite price cuts that ate into margins and at the same time ate into cash flow, turn that fortune around. That's the reality. The dream that Musk is selling is one of robo-taxis, of autonomous vehicles. Are you buying the dream, Richard?
Well, that's it, isn't it? It's selling the dream to try and kind of get investors not to look at the fact that we've had $60 billion of revenues taken out of estimates for next year, and EPS estimates have gone from $8.50 down to $3, which is why you wouldn't be buying the stock even here based on that earnings trajectory. But, we can all now look forward to a robo-taxi launch in August, and then, FSD and solving autonomy at some point later this decade. And for us, we're just still lacking a bit of conviction in that. And as you say, there was just some confusing comments about that cheaper vehicle launching next year. Elements of the new platform, but using the existing lineups, are we truly going to be able to get that mass market price point that's going to drive the next sort of wave of EV growth?
Good morning, Richard. So you don't sound at all convinced that you should be buying this stock at this level. What was the most disappointing part of it? I mean, it was almost like, if you're not with me, you're against me. If you do not believe in autonomous driving, don't bother owning my stock. If somebody doesn't believe Tesla is going to solve autonomy, I think they should not be an investor in the company. It's very Machiavelli challenge back to the bears.
And Elon loves challenging the investors generally, and especially the bears and the shorts. But we think autonomous driving is one of the hardest challenges to solve for in AI. And Apple said that categorically. And so we just think it will happen, but it's probably just going to take longer than most people expect, and certainly longer than Elon expects. And as a result, we're probably not going to see that impact to the earnings of Tesla till much later in the decade, which for us is a bit longer to be putting into an investment horizon for the stock today.
And Richard, to that point, you write in your notes about how we still need to think about price to earnings. Valuations matter, despite what some have said, but it's figuring out that earnings portion that is really key. You mentioned it in talking about Tesla, but for the wider universe of AI stocks, how can we figure out what future earnings is? How can we appropriately price these stocks when our puny little human minds can't actually grasp what the future of AI is?
And that's the great question, and hopefully why me and my team won't be replaced by AI just anytime soon. The poster child for this was NVIDIA. If you'd figured out that you needed a GPU and you needed an NVIDIA GPU to train these large language models, you would have understood that earnings weren't going to be $6 for this year. They were going to be north of $25. And actually, NVIDIA 18 months ago was on 6 times PE, and any value investor in the world could have bought it. And I think what you've got to look at is, where does this technology go from here? As we go from training to inferencing to building out and scaling out these great AI products and services we'll see over the next few years, what's that going to drive in terms of semiconductor earnings for beyond NVIDIA, for some of the cloud platforms, for some of the software companies, and come to some reasonable expectations for what that E can really look like, and then you can get more comfortable with the valuations. The problem is there are only going to be a few winners. This is a winner-takes-most industry. There are only going to be a few winners in AI, and your key as a stock market investor is to identify them and not get caught up by the guys who are going to be left behind.
Well, that's a flesh wound to everybody else is saying that the picks and the shovels, etc., of AI are going to be the winners, and that's where you go for breadth. So I take it maybe you're going to push back on that. You say that AI, understanding the E, as Danny said, as part of the PE, we often get this wrong at inflection points in history of when we have these big evolutionary moves. So who then, in your view, has got the best capacity to monetize AI efficiently, at cost, and with profit in the near term?
Yeah, so I think we're going to see some of the cloud platforms deliver earnings over the next week or so, and I think you're going to start seeing some more proof points that we're starting to see that re-acceleration of cloud growth, and a catalyst for that is the shift to AI. Both in terms of being able to having to shift your data into the cloud to really leverage the benefits of generative AI, and then obviously some of these AI services and products that the likes of Amazon and Microsoft are now offering. It's still early days, but I think if we can get some proof points and more tailwinds to a Microsoft, to an Amazon, that's going to give us comfort that we can start extrapolating that into the future to much more meaningful numbers 2 or 3 years out. Still very early, I think, for the software companies. Even a Microsoft Copilot has only just launched a few months ago, so we still need a bit longer to get comfortable as to when those penetration rates are going to get really meaningful. That's still probably 2 to 3 years out.
Well, Richard, you hit the 2 big companies that are reporting earnings tomorrow. What about the one today? What about Meta? Has Meta successfully leveraged AI and its algorithm and Reels to have an actual competitor to TikTok?
And that's a great proof point that generative AI can truly have a meaningful impact on your business. They're harvesting the rewards of investing in this technology, a couple of years ago, and everyone was criticizing Mark Zuckerberg at the time, but now they're seeing a meaningful impact in terms of engagement, in terms of the ROI on that ad targeting, which means that their advertisers are willing to spend more. Obviously, talking about a Tesla versus a Meta, a stock that's up 40% versus a stock that's down 35%, you have very differing expectations. And as we heard earlier, the expectations for Meta are a lot higher. But they should be able to deliver to that. And I think the reaction on the stock will be much more around more extreme positioning around Meta, and whether some of that's washed out in the last week or two or not. But the fundamentals are very solid for the company, and the valuation still remains fairly attractive relative to the market.
Yeah, and still so much riding on these companies to perform this quarter to lift up the overall stock market. Richard, I'm afraid that's all we have time for. Please come back and join us. Richard Claude of Janus Henderson, thank you. All right, Manus, let's get to some of the other top stories that are trending on the terminal this morning. Kering shares tumbling. They've warned that first half profit will drop 40 to 45%. Sales at its biggest level, Gucci, are slumping on weak China demand. It did hire a new creative director for Gucci last year, but it has warned that the turnaround will take time with a cooling luxury market.
UBS Chairman Colin Kelleher says the Swiss government's plan to raise capital requirements is, quote, the wrong remedy to the failings that brought down Credit Suisse. UBS is holding its annual general meeting today in Basel.
CVC Capital Partners is exploring options for its controlling stake in the Italian drug maker Recordati. The buyout firm is said to be informally reaching out to some potential buyers to gauge interest in a deal. Recordati's products include treatment for cardiovascular disease and coughs and cold.
Coming up, the former President Trump leads President Biden in most swing states. The latest Bloomberg Morning Consult poll on Bloomberg.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg Brief, Danny Berger and Manish Krani in New York. President Biden, Manish, is leading in just one state, Michigan, out of 7 swing states as the former President Trump picks up steam in April's Bloomberg Morning Consult poll. For more, we're joined by Bloomberg's Anne-Marie Hordern. Anne-Marie, I mean, it's hard to interpret this as anything but bad news for Biden, but it seems the overriding message is it's about the economy, it's about inflation.
Absolutely. And what you continuously see in our poll is that this is what voters are going to go out and vote for. It's back to that saying, it's the economy talk And when you talk to individuals at Morning Consult, the firm that we do this poll with, what they will say, and Matthew Monday said this, is that more and more you see voters linking Bidenomics to Biden, it's in his name, but also the inflation rate to Biden. So it doesn't seem to be landing on voters' minds when you say the rate of inflation is coming down, because they're thinking of what were the price of goods before you went into office and where are the price of goods now. And that really seems to be weighing on all these concerns. And this is going to be a big problem for this administration, this campaign, if the inflation rate, if we keep seeing these bumps in the road or hot CPI prints before November 5th.
So essentially, he's lost the bid that he had from the State of the Union, the nice bid, the nice bump. And here we are, 1 in 5 expect inflation and interest rates to be lower at the end. Again, this is about perception now and where we are as we go towards the end of the year and towards that election.
That's right. So when you look at the expectations voters have, is that they don't seem to think that it's going to get any better.
No.
This issue, which is why Biden right now is only leading in one of the swing states. That's Michigan. It also seems that he's having a lot of tough trouble in places like Pennsylvania and Wisconsin. This blue wall really seems to be a difficult path for Biden to win the election if he doesn't shore up that blue wall, which is also why you see him visiting places like Pennsylvania. Last week, he spent, 3 days in Pennsylvania. This is really important for him to try to win this election. It's going to come down to these 7 key swing states. Then you see what the campaign is doing. What they're doing is they're going after things like trying to tap into voters' concerns about things like abortion. And that's actually something that does land, and you can see that in our poll, does land on our voters, especially suburban women. And this is going to be a deficit Trump has with these people because he hasn't exactly landed the message. He's trying to assuage their concerns, but at the end of the day, he put some of those justices on the court that ended up striking down Roe v. Wade.
Right.